If you've been watching Bitcoin recently, you've probably noticed something different. This time, it's not just chopping sideways, it's starting to drift downward. That might not sound dramatic. Bitcoin has fallen many times before. But what makes this moment interesting is the broader context. Gold has been strong. Commodities have held up. Trust in fiat currencies remains fragile. Debt levels are still extreme. Geopolitical tension hasn't gone away. In an environment like this, Bitcoin is usually expected to act as a hedge, as a release valve, as an alternative. Instead, it's weakening. When markets behave in a way that contradicts expectations, it's usually a signal that something deeper is happening. For a long time, Bitcoin lived mostly outside the traditional financial system. When it crashed, it hurt people inside crypto. When it rallied, it excited the same group. The rest of the world mostly just ignored it. That separation no longer exists. Today, Bitcoin is deeply connected to global finance. Large investment funds hold it. Public companies keep it on their balance sheets. ETFs have tied Bitcoin directly into retirement accounts and traditional portfolios. Banks, custodians, and institutions now have exposure, even if indirectly. Once an asset reaches this level of integration, its price no longer reflects only belief or speculation. It starts to reflect risk, and not just market risk, structural risk. This is where a common misunderstanding comes in. Most people assume Bitcoin's biggest threats are things like regulation, market crashes, or competition from other cryptocurrencies. Those risks are visible. They are easy to talk about. They show up in headlines. But there is another category of risk that doesn't move fast, doesn't make noise, and doesn't announce itself clearly. It sits underneath everything. Bitcoin is built on cryptography. At its core, it relies on a very simple rule. Only the person who controls a private key can spend the coins. The network doesn't know who you are. It doesn't check identities. It only checks whether the math proves ownership. As long as that rule holds, Bitcoin works. If that rule ever becomes uncertain, even for a small part of the system, trust starts to erode. This is where quantum computing matters, and it's often misunderstood. Quantum computers are not magic machines that suddenly break all security. The machines that exist today are slow, expensive, and highly limited. There is broad agreement among Bitcoin developers that quantum computers are not an immediate threat right now. But security planning isn't about today. It's about whether a system can adapt before a risk becomes real. Bitcoin uses different types of cryptography for different purposes. Hashing secures mining and block creation. Even if computing power improves, the network can adjust difficulty. That part is relatively robust. Digital signatures are different. Digital signatures are what prove ownership. They are the lock on the door. With today's classical computers, deriving a private key from a public key is effectively impossible. It would take longer than the age of the universe. That's why Bitcoin addresses can be shared openly without concern. Quantum computing changes that assumption. A sufficiently powerful quantum computer wouldn't need to guess private keys or try random combinations. It could mathematically derive a private key from a public key using known algorithms. This isn't controversial. It's well understood in cryptography. The real uncertainty is when, not if. Here's the part that makes this more than a technical issue. Quantum computers don't need to break all of Bitcoin. They don't need to attack every wallet. They only need access to public keys. And not all Bitcoin addresses expose public keys in the same way. In Bitcoin's early years, addresses were essentially raw public keys. Once coins were received, the public key was visible on the blockchain forever. Those coins are permanently exposed. Over time, Bitcoin improved. Modern address types hide the public key until coins are spent. You can receive Bitcoin without revealing the underlying key. But the moment you spend from that address, the public key appears on-chain. From that point forward, it can never be hidden again. This creates uneven exposure. Some coins are far more vulnerable than others. Older wallets, reused addresses, certain address types that trade security for efficiency or convenience. Estimates suggest that a meaningful portion of Bitcoin's total supply sits in addresses where public keys are already exposed. And this is where incentives start to matter. An attacker doesn't need to steal all the Bitcoin. They don't need to collapse the entire system. They only need to show that the system can be compromised. If even a limited number of high-profile wallets were drained, the impact wouldn't be limited to those losses. Markets would react immediately. Funds would reduce exposure. Risk models would change. Liquidity would dry up. Fear spreads faster than facts. At that point, the problem isn't who lost coins. The problem is what people believe might happen next. This is why Bitcoin is increasingly viewed as more than a financial asset. At its current size, it influences confidence and stability. That makes it attractive as a target for disruption, not necessarily for profit, but for leverage. The hardest part of this problem isn't the mathematics, it's coordination. Bitcoin is decentralized by design. There is no authority that can force an upgrade, no emergency switch, no central decision maker. Any meaningful change requires agreement across developers, miners, node operators, exchanges, custodians, and users around the world. That process takes time, years, not months. Even when there is agreement, not everyone moves at the same speed. Some wallets are abandoned, some keys are lost, some holders are inactive, some coins will never move. A transition to quantum-resistant cryptography would have to happen gradually. It wouldn't be instant. It wouldn't be retroactive. Coins would need to migrate voluntarily. If that process starts early, it can happen calmly. If it starts late, the network is forced to react under stress. Fees rise, people rush, coordination becomes harder, not easier. To really understand what's happening to Bitcoin's price, you have to look at how institutions think about this risk. Large institutions don't approach Bitcoin the way individual investors do. They are not trying to predict short-term price moves or time market cycles. Their focus is much simpler. They are identifying risks that could cause permanent damage and deciding whether those risks can be managed, hedged, or avoided altogether. For an institution, a risk does not need to be likely to matter. It only needs to be plausible and asymmetric. If the downside is large, difficult to insure against, and hard to respond to under pressure, it immediately becomes part of the decision-making process. Quantum risk fits that profile almost perfectly. From an institutional perspective, the problem isn't that quantum computers are about to break Bitcoin tomorrow. The problem is that if Bitcoin's underlying cryptographic assumptions were ever challenged, there is no clear, guaranteed path to a fast or orderly fix. There is no central authority that can step in, no emergency protocol that can be enforced, no way to force millions of users to upgrade at the same time. That uncertainty has a cost. Over the past few years, this has quietly changed how institutions treat Bitcoin exposure. You can see it in how products are structured, where risk disclosures have become more explicit about protocol-level threats and cryptographic changes. You can see it in how ETF issuers and custodians carefully state that any fundamental security transition would require broad coordination with no assurance of timing or success. For a retail investor, those disclosures might look like standard legal language. For institutions, they are important. They define worst-case scenarios. And when institutions see a risk that cannot be easily hedged, they have to adjust. They reduce position sizes. They demand higher expected returns for the same exposure. They rotate capital toward assets with fewer unknowns. These decisions happen slowly and quietly, They don't show up as headlines, but they do show up in price behavior. Institutions also understand something that is easy to underestimate from the outside. Coordination risk can be more dangerous than technical risk. Banks, governments, and corporations rely on cryptography too, but they are centralized. If an algorithm becomes obsolete, they can rotate keys, change standards, and enforce upgrades internally. Bitcoin can't do that. Every meaningful upgrade in Bitcoin requires voluntary agreement across a decentralized global network. There is no central authority that can issue an order and expect it to be followed. Developers can propose changes, but they cannot enforce them. Miners can signal support, but they cannot force users to act. Exchanges, custodians, wallet providers, and individual holders all move on their own timelines, based on their own incentives. Even when there is broad agreement that a change is necessary, adoption is slow by design. Bitcoin values stability over speed. That has always been one of its strengths. But it also means that transitions unfold over years, not weeks. Some users upgrade quickly, others wait until they are forced to. Some never upgrade at all, and some wallets are permanently lost, unable to move or change under any circumstances. There is also a very practical limitation that often gets overlooked. Bitcoin can only process a fixed number of transactions per block. That doesn't change just because people are in a hurry. In a calm environment, that limitation is manageable. In a rushed one, it becomes a choke point. If a large share of holders suddenly tried to move their coins to safer address types, the network would not scale to meet that demand. Transactions would pile up almost immediately. Confirmation times would stretch out. Fees would rise sharply as users compete for limited space. At a certain point, the fee required to move funds could exceed the value of smaller balances entirely. Some users would be priced out. Others would simply be unable to act fast enough, even if they understood the risk perfectly. This isn't a hypothetical flaw. It's a known constraint of how Bitcoin works. And once you understand that, the timing issue becomes much clearer. A transition like this can work when it happens gradually, over years, with plenty of room for mistakes and delays. But under pressure, the same process turns into a bottleneck that amplifies stress instead of resolving it. That is the scenario institutions model. Not a clean upgrade, not a coordinated migration, but a crowded, time-sensitive rush through a system that was never designed for urgency. And when you price that possibility in, even at low probability, it changes how much risk you're willing to carry today. If you got this far, I'd really like to hear your take. Do you think this risk is being priced in for a reason? Or do you see it differently? Let me know what you think in the comments.